We have never had a period of time in U.S. history, or indeed throughout the world, where both bonds and stocks and real estate are all in a massive bubble. Never. This has never happened before. And the 60-40 portfolio isn't going to protect you. So you have to be bullish when it's prudent, but you have to get out of harm's way when you need to. I believe we're headed for a 100% crypto-backed currency. I call it a Fed coin. You call it the ECB coin. You call it an IMF coin. I don't know. I mean, I can tell you one thing. It's not going to be Bitcoin. So central banks aren't going to adopt Bitcoin because it's a fiat supply. So they're going to have their own coin, then probably engage in negative interest rates in nominal terms. And that means you're going to lose purchasing power like mad in the bank. So you have to subtract inflation from the fact that you're getting a negative yield. So, you have 100,000 in the bank. It's, let's say, 10% of negative interest rates. So you're going to have 90. So don't keep the money in the bank. What are you going to do? You're going to spend it, which is going to create more inflation, get the velocity of money turning over. So you're going to be, you're going to lose money purchasing power left and right. So that's why you would own gold. Not so you can so much borrow. You can still spend your cryptocurrency from the federal government. But how do you maintain your savings? How do you maintain your purchasing power? How do you maintain your standard of living? It's through the process of owning gold. If and when the announcement comes out that the Fed is adopting, a 100% cryptocurrency, and your physical cash, just like Roosevelt did in 33, give me your gold. I want your gold. I'll give you some dollars back. You won't like what happens next, though, because your dollars will be devalued. Well, this is exactly what's going to happen again. I mean, don't be fooled. They say we're going to a cryptocurrency. Give me all of your paper. You have X amount of time to get your, dollars out of your pocket or be fined or imprisoned. And you're going to have the same amount in the physical. Your physical dollars will be converted to electronic dollars in the bank. You can't take anything out anymore. Cannot take money out of the bank. You can only spend it. Okay, that's when the starting pistol goes off. You better rush into gold because that what's going to happen next. Otherwise, it'll be too late before everybody else realizes what happened.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Michael Pento is the founder of Pento Portfolio Strategies, and he joins us this Monday, November 16, 2020. Michael, thank you for coming back on the show.
Thanks for having me back on, Dunnigan.
We want to keep having you back on because you are a contrarian money manager who keeps an eye out for the good of his clients and actively seeking what are the current opportunities and risks available or present in the current landscape, and how you can keep people on the right side of much as possible of those. So if we could just maybe take just a couple minutes to get a real high-level view of what your view is right now of the biggest opportunities and risks that are pressing to your mind at the moment as we just went through this presidential election, we're heading into the end of the year, et cetera. What are you looking at that you think people need to be aware of to keep their eye on?
So many things. So again, thanks for having me back on. Again, I really appreciate being on with you and your audience. Your audience asked some good questions. So I am a money manager, and that's my primary source of income. So I'm not a perma bull or a perma bear. I just want to make my clients money all the time. So let's look at the balance sheet. You look at the left side and the right side of what's going on right now in the macroeconomic spectrum. So right now we have the virus is raging out of control. Hospitalizations are at a record. Deaths have started to spike up as well. If you look at the fact that we have two presidents right now, that's also kind of a bad thing. We have two people claiming to be president of the United States.
One claiming to be president-elect, yeah.
Yeah, one's claiming to be, both were claiming that they belong to be president of the United States on January 20th, 2021. And then, of course, you have the fiscal cliff that we're going over. That's on one side of the ledger. The other side of the ledger is like, hey, we have a lot of optimism about these vaccines. And I did predict to my clients, I said we're going to sell all of our miners right around early fall timeframe. And we did. So we're still staying at around 15% physical gold. But we sold all of our miners because of what I called and predicted would occur. I called it the vaccine dead zone. I don't know if I mentioned it on your program,
No.
but I believe my clients could verify that we did. We talked about it and we acted on it. So the vaccine dead zone, which would do the following: it would serve to increase long-term bond yields and send real interest rates rising in the short term. So we're in the middle of that. I mean, we had the first vaccine from Pfizer that came out. Then Moderna came out even, today, 94 or 95% effective is even better than the measles vaccine, as opposed to the Pfizer, which is about 90 something percent, 91% effective. Both very effective. Will wipe out the entire disease if you believe in vaccines and if you're going to take the vaccine. We can get into that later, though. But right now, the market is believing that this is great news. And this is going to bring us back into a huge rotation between what was working and what was not working. So from growth to value. And because I'm an active manager and I have a 20-point model, my model picked up on that. And that's exactly what we did. We rotated from growth, from defense into value. And it's working out right now. Now, there's a lot of things, Dunnigan, that can derail that. First of all, we don't really know how effective this vaccine is going to be. We don't know how safe it's going to be. We don't know how many people are going to take it. We don't know if the virus is going to mutate. But then again, I don't want to sit here, short the market. I closed out the shorts too a little while ago too. So I don't want to sit here owning a completely defensive posture when Wall Street, the internal components of my model, are signaling that Wall Street believes we are headed towards a period of growth and slight increase in inflation. That's very bad news for people who are short, and it's not terribly great news for the gold miners in the short run. The question is, when is that going to change? I am monitoring the yield curve dynamics right now. I want to see what happens with long-term rates. I think to give hope to those who want to get back into the miners right away. I'm not doing it right now, but I plan to in the near future. The news that came out from Moderna, even better than Pfizer, did not serve to spike long-term rates the way I thought it would or could. And that means one or two things. Either this vaccine the vaccine news is out and it's time to sell the news. It's not going to be as effective. Or, and this would even be better news, or if the $120 billion per month of Fed monetizing of debt is all going on the long end of the yield curve, buying long-term bond yields, sending those yields lower. That is the best news for gold. So we're going to watch that. We're going to monitor it. If I see the yield curve start to contract a little bit, especially when nominal rates coming down in the long end, that's your signal to get back into the gold miners.
When you describe the complexity of the different factors that you weigh when looking how to manage your clients' monies, it really impresses me that people would do well to consider how much there is going on, how many moving parts there are, and how many things there are to consider. So we're grateful to have you here, kind of seeing it, sharing us how you see it from your perspective. We have some questions from viewers. This one comes from Black Oak Property Maintenance, who says, when working with clients, do you even consider Social Security, or do you plan as if it won't exist? If they can print phony money for QE to infinity, why can't they just dump a couple trillion into the Social Security fund and keep things going? Or do you expect your clients and the rest of us to be all on one UBI check and Social Security, Medicare, and food stamps, et cetera, will go away?
Oh, my God. Well, okay. I've always said it's highly likely, almost 100% guaranteed, that you will receive 100% of your Social Security check in the mail. The only question is, what will it buy you? That's the big question. So obviously it's going to buy you less. So how do you hedge for intractable or runaway inflation? That's what you have to ask yourself. So I'm not concerned about them. For a very long time, the government reneging on its obligations, its unfunded liabilities. That's something that's going to happen only if we enter into a period of protracted hyper or runaway inflation.
But I mean, the way that you described that makes perfect sense. That you said that you don't see them reneging on their obligations. In other words, you don't see them being honest about regaining a gain. If they're going to do it on a nominal basis, but knowing full well that by policy they're corroding the value of the thing that they're giving you.
Of course. I mean, so just so you understand, if they were to renege on their obligations, which is an explicit default, think about bail-ins or saying, you had 100,000 in the bank, now you've got 70,000 in the bank, or your Social Security check would be 3,000 a month, it's going to be 1,000 a month. I mean, that is extremely deflationary, extremely deflationary. And what is the one thing that we're hearing from central bankers? That they're the most absolutely covetous. They want more than anything, more desirous more than anything. They want not only 2% inflation, they want 2% plus inflation. So 2%, I'm writing a commentary right now called The Evolution of the Fed. It used to be that the Fed wanted stable prices. Then they defined stable prices as 2% inflation. Now it's 2% as a minimum floor.
And they got to catch up.
And now they call this symmetric targeting. It's one of their tools that they use. Come on. Inflation is going to be running well above 2% for the duration that it was below 2%. And by the way, if you look at history, I think I talked about this the last time I was on. If you look at the history of the Fed, they have a very poor track record of sticking the landing on any inflation target whatsoever. So I would imagine that once they get their 2.5% on core PCE, it's really going to be 8-9% or higher, and it's going to take off from there. So, by the way, I mean, I don't want to come off here sounding too bullish here. There's still 21 million people collecting unemployment in this country, some sort of unemployment check, pandemic unemployment. There were 700,000 initial jobless claims. That's higher. That's 700 and something. It was low 700s. That number was higher than any 1 week period throughout the entire Great Recession. So, and this is 10 months after the virus first appeared. So I don't want to sound too bullish. People, listen, I don't want to be ashamed that I'm making money for my clients by buying, small cap growth stocks. I'm making a lot of money on that. Thank God. But, don't think I'm sitting here saying, like everybody else, 2021 is going to have, record growth. We're going to be booming, like I hear on, financial news networks. You're going to have a transition of the way you buy things. So you instead of consuming, everybody I know painted their house, or they did some kind of addition, or did something to their home with all the stimulus checks that they received. Well, instead of doing that, they're going to go out to dinner and go on vacation. So the consumption habits are going to change. But booming economy from what? There is no fiscal stimulus package even being discussed any longer, right now, right? We don't know who's going to be the president of the United States in 2021. I mean, I think it's going to be Joe Biden, but are you sure? Are you really? Because President Trump shows zero sign of conceding anything. So what about the possibility of God forbid, a civil war, at least a limited one in this country? Look at that million MAGA march that took place in D.C. this weekend. I mean, we're having the seeds of this already spring up, but Trump has not been escorted out of the White House yet. And will that happen willingly? And will people, ascend to that new power? So there's a lot of things going on in this economy, and I want to leave time for your questions, but I don't want to come across too bullish. What I am saying is that the model components that I very carefully hand selected, I've been doing this for 30 years, okay? And over those decades, I've developed a model that lets me know when to get more bullish, more bearish, and on what sectors. And right now it's saying, hey, green light. This could all change next week. If you had me on next week, or maybe 3 weeks from now, you have me on and you go, Michael, you were bearish, bullish before. Now you're bearish. What happened? Are you lying to me? Are you making up stuff up? No, I am saying to you, you have to be an active manager in this construct. We have never had a period of time in U.S. history, or indeed throughout the world, where both bonds and stocks and real estate are all in a massive bubble. Never. This has never happened before. And the 60-40 portfolio isn't going to protect you. So you have to be bullish when it's prudent, but you have to get out of harm's way when you need to.
You were talking a minute ago about ordinary people being able to expect that their Social Security checks, for example, would stay nominally 100%. And most people, they know there's a pinch in their pocketbook, and they're getting the feeling that they know a buck ain't worth what it used to be. But that plays out into a much bigger stage when you look at some of our overseas international trading partners or bond investment partners. Just Me asks, why do other countries accept a corrupted and easily printed fiat like the US dollar for trades?
Okay, so let's look at total debt to GDP. I'll answer the question this way. The US is 400% debt to GDP. Well, should I like what's going on in France? Their debt to GDP is 650%. Ireland is 800%. So if you use the euro, you're saying, I want to sell dollars. Well, if you sell your dollars, what are you going to do? Buy euros? Are you going to buy renminbi? It's not even fully convertible. Are you going to buy yen? I mean, which country do you really trust? So I believe, and I've said this many, many times, that all fiat currencies are losing their value against precious metals. I would not look for the manifestation of the dollar's weakness to be against primarily the euro or the yen. Look for fiat currencies to crater in purchasing power en masse against gold.
Okay, now that moves right into this next question. Ice9 says, Michael, if we move our US dollars into physical gold and silver, then the government forces us into online-only banking. How can we spend our precious metals? Barter? Do you think some states will keep metals legal as a form of payment?
They can't do that tomorrow. So it would be a process. But I believe we're headed for a 100% crypto-backed currency. I call it a Fed coin. You call it the ECB coin. You call it an IMF coin. I don't know. I mean, I can tell you one thing. It's not going to be Bitcoin. So central banks aren't going to adopt Bitcoin because it's a fiat supply. So they're going to have their own coin, then probably engage in negative interest rates in nominal terms. And that means you're going to lose purchasing power like mad in the bank. So you have to subtract inflation from the fact that you're getting a negative yield. So, you have 100,000 in the bank. It's let's say 10% negative interest rate. So you're going to have 90. So don't keep the money in the bank. What are you going to do? You're going to spend it, which is going to create more inflation, get the velocity of money turning over. So you're going to be, you're going to lose money purchasing power left and right. So that's why you would own gold. Not so you can so much barter. You can still spend your cryptocurrency from the federal government. But how do you maintain your savings? How do you maintain your purchasing power? How do you maintain your standard of living? It's through the process of owning gold, primarily gold, not silver. Because silver, again, and there's a lot of silver bugs out there. Silver has a lot of industrial components to it. So if you have inflation in the context of booming global growth, silver outperforms gold, because silver is not money. It is not just a currency. It's also, as I said, it's a base metal.
Industrial commodity.
Industrial metal. Gold, on the other hand, is pure, real money. Okay, so that's totally different. It acts like a currency, much lower volatility regimes than silver.
Related question here from Deerfly Guy. Mike, if gold and silver are the best forms of money in which to store one's wealth, why is it that it seems that only those times precious metals perform positively is during times of crisis and market chaos? If PMs are good stores of value, why don't they perform much the same in all sorts of financial climates?
Well, if I gave you the choice of owning the S&P 500 or gold since the year 2000, which one do you think would have done better? This person would probably say, oh, well, the S&P 500. No, gold. Gold has done fantastic since it was in the low 200s back in the year 2000 to $1,900 an ounce today. So gold does well over time. Yes, it can be volatile. It's not as volatile as silver. Currencies can be volatile too. Stocks can be volatile too. I mean, look at the halving in 2000, the halving in 2008, 30% drop in 2018, the 30-something% drop in early 2020. So, nothing is exactly stable in this world because guess what? Then again, everything is artificial. But if you ask yourself this question, what is going to happen in the long run? Now, I can't do this. I don't have the luxury of telling people. Some people do. I don't have this luxury because I like to make money for my clients as often as possible. Helps me out because I'm a fiduciary charged on assets under management. I can't tell you, the U.S. non-financial business debt is now $17.5 trillion at a record as a percentage of GDP. The total U.S. debt right now is 400% of GDP. There's no way we can survive this bubblicious economy without monetizing more and more debt. So over time, gold is going to rise. So just own it. By the way, I have physical gold. As a matter of fact, I bought some also from you. And your services were fantastic, by the way, if you don't mind me saying. Very prompt and very nice. So yes, own some physical gold for the long run, but I can't sit here and tell you just own 100% of your portfolio in gold. You're going to be fine, or 50%, whatever number you want me to pick. You have to actively manage through these epic bull and bear cycles. For instance, I could say from the year 2000, 2020, gold outperformed the S&P 500. But wouldn't it have been nice if you were to sell your gold in 2012? Okay? Wouldn't it have been nice if you were able to do that? I wasn't able to get that one exactly right either. I think there's been improvements with my model to do that next time that happens. But wouldn't it be better if you could sell it at $2,000 an ounce and buy it back at $1,100 and then ride it back up? Well, that's what I am charged with doing. But if you don't want to do that, you don't want to put money with me, I believe over the long term, the value of the dollar will lose ground against gold. So just buy some and put it away.
I wanted to make sure we have it clear because you made a really strong point a couple minutes back. If we get to this, and a lot of people are already there. They're holding all of their funds, like in the, for example, the banking system, in which case it's just numbers on a screen. It's not really anything. But you pointed out that when the official policy becomes negative nominal interest rates, and then you have the real rate of inflation dragging you down even further, those two combine as this double whammy to really corrode the value. So even though you may have nominal, your numbers may stay the same in your bank account. They're not explicitly doing bail-ins or whatever, but those two combine in a.
Well, in a way, it almost is a bail-in. I mean, they're not officially doing. They're not saying you have 100,000 and it's going to be 90,000. They're saying that we're going to charge you 10%. You're going to have a negative interest rate of 10%. Well, what is negative interest rate? They're charging you to keep your money there. So if they go down this road, I would assume, and we'll talk. You can have me on the show many times. If and when the announcement comes out that the Fed is adopting, a 100% cryptocurrency and your physical cash, just like Roosevelt did in 33, give me your gold. I want your gold. I'll give you some dollars back. You won't like what happens next though, because your dollars will be devalued. Well, this is exactly what's going to happen again. I mean, don't be fooled. They say we're going to a cryptocurrency. Give me all of your paper. You have X amount of time to get your, dollars out of your pocket or be fined or imprisoned. And you're going to have the same amount in the physical. Your physical dollars will be converted to electronic dollars in the bank. You can't take anything out anymore. Cannot take money out of the bank. You can only spend it. Okay, that's when the starting pistol goes off. You better rush into gold because that what's going to happen next. Negative nominal rates, and that's going to mean that your real interest rates, whatever they say, negative, it's not going to be 10, but -1, -2, it's going to be -10 in real terms. You're going to lose 10% of your purchasing power per annum. So get into gold right away when that happens. Otherwise, it'll be too late before everybody else realizes what happened.
That's what I was going to say, man, is we have the saying, I'd rather be 7 years early than one day too late, because it's that one day that you, the ordinary man on the street, gets the idea, oh, dang, I just saw this on the news. Now I know. Now I can get ahead of everybody else. Yeah, good luck.
Listen, gold can't, like I said before, gold is not a stock. It trades like a currency. But can gold move 5% in a day? Yeah. And it can move that way for many days in a row. Look what happened with the announcement of the Pfizer vaccine. Gold, physical gold lost 5% of its value on that announcement. Even this morning, when Moderna's vaccine came out, gold was down 20% before it came back. The minute before the announcement, because the Wall Street works on insider information. That's why there's a three little pig picture in my office. So it was all insider information. The insiders knew that the Moderna announcement was coming out, so they were pounding gold from like 6:30 in the morning to like 7 o'clock a.m. when the announcement was official. So gold can move very quickly, and on that announcement of the Fed launching a cryptocurrency, you're not going to have much time.
In fact, you're not going to be on the inside probably of that pre-announcement.
Yes, you'll see gold will be going up for no known reason. You'll see gold go up, 7% a day for like 3-4 days. Really. And then you'll say, I wonder. And you'll see someone on CNBS will tell you, oh, I believe it's because of the conflagration between China and some
pacifying story. Yeah.
Yeah. But the real reason is, hey, the insiders now know that your cash will now have to be turned into the government.
James Reddy says, I'm considering having Michael manage something for me, but concerned that things may get so crazy that even someone as good as Michael may suffer losses. Several prominent investors have thrown in the towel lately. Probably thinking about some high profile. I mean, we certainly have seen back in the fourth quarter of last year, we saw Ray Dalio make some placating comments about things. We've heard Warren Buffett make some placating comments before he made moves that were contrary to what he just said and things like that. So.
Yeah. Well, I understand. I have a track record. I could send you the information on the track record. Pretty steady track record of making money. Not a tremendous amount of money all the time, but a very good year this year. Don't like to lose money very often, that's for sure. I could tell you that, I pride myself on trying to be able to make money in all markets. Like it was that guy Kramer always say, it's always a bull market somewhere. Well, there's always a bull or a bear market somewhere. That is true. And you have to know what to own at the right time. No one's perfect. I'm certainly not God, very far from it. And I make lots of mistakes, but I also get a lot of things right. And I think you'd be very pleased with your ability to make money here. And also, by the way, this is not a hedge fund. I operate it like a hedge fund, but I don't lock up your money. So anytime you want to take money out, it's completely liquid. You let us know, and it's on its way. T+2 is a trade. So your trades would settle in 2 days, and you can be out of here.
It reminds me, when you explained it to me, a little bit closer detail, it's almost like having cruise control on your vehicle. You remain in complete control of what you want the vehicle to do, but if you decide to put it into auto speed control, you can, and then in that case Michael takes over, and then you can just anytime you want, you can undo auto control.
Yeah. I don't know, I don't know what the alternative is, though. If you think about what Wall Street has done to people over the years and decades, and it's just starting. Maybe back in the 60s, you could buy and hold stocks, 50s, 60s, certainly. 70s were a horrific decade. 80s were great. 90s too, unless you were in 1987, didn't turn out too well. But now we're at now, Dunnigan, we are now, if you look at the market cap of stocks as compared to the economy, 175%. That's how egregiously overvalued stocks have become. So it's just inherently so dangerous. And if you want to, go out and lock your money with the government for 10 years, you get less than 1%. So there's just, you could say, okay, if the market was to collapse again, like it has a habit of doing very often now, it's like birth pangs becoming more and more intense and shorter duration. What are you going to do? Say, okay, well, my bond portfolio was a ballast. It didn't do anything. You made a few percent. You lost 40% or even greater, but you made 6% or 7% on your bonds. That's if maybe you might not make anything, because could it be that bonds and stocks collapse in tandem? Absolutely. And that's one of the things I'm worried about. I'm monitoring. What happens when inflation begins to run out of control? What does the Fed do? What does the market do? What happens if interest rates really start to get, spiraling out of control? And that's, by the way, exactly what happened in 1987. Inflation started to tick up in the early part of that year, started to rise significantly by October. That put the Fed back in play. People thought the Fed was going to have to raise rates. And you saw, 23% crash in one day. Can't happen again because of circuit breakers. But it could happen over a few days at a minimum, and then it could keep on going from there. Nobody knows. So if you get a situation where the market is so egregiously expensive like it is today, all markets, real estate, equities, and bonds, and then the Fed is forced to jam on the brakes. That's the real fear here. The carnage could be complete and abrupt.
This is related to what you just said. Carolina Contracting says the name of the game is going to be lose less more than everyone else that morning. You have to have an advantage when you have an active manager. People who have their stuff parked in a 401k are going to take a beating.
100%. I think we just answered the question before it was asked. I mean, I've had a lot of friends, even family members, call me up and say, I'm in my 401k, they have their sub accounts that just like, you can't move as fast as you want to, or they're with managers that if you go more than like 5% cash, you get a call from the compliance department. Like, what am I doing? You have to be able to be liquid and move faster than everybody else in this environment. So I can go 100% cash. Nobody calls me because I'm allowed to do that as a fiduciary and as an independent investment advisor. I have my own compliance department here. So, but it's the right thing to do. You have to be able to protect when it's warranted. You have to be able to protect when the facts change. So look, as I said before, I don't want to repeat myself, but look at what happened in 2018 when the market really took it on the nose when they thought the Fed was going to raise rates to 3%. 2019, the repo crisis didn't crush stocks right away because the Fed rode to the rescue with what? QE and reducing rates. 2020, the pandemic. So there are times when you're going to want to be out of this market and short the market. And I can't get them all right because it's impossible. I mean, but I did manage to get this virus right. Did worry about the repo crisis and react to it and predict it to some degree. So I don't get everything right, but you try to get as much right as possible, and you can only do that in an active management rubric.
Everything we've been talking about is about reacting to, responding to, or sometimes predicting what's about to happen based on insight, intel, information. Online Advertising Net asks, Michael Pento is one of the best money managers in America. Question, running a deflation/inflation econometric model is only as good as your data feeds. Where do you get your inflation data? Shadow Stats, Chapwood Index, government, other?
Okay, so I do not. That would be someone who reacts to inflation. You can't. So inflation is a lagging indicator. So you throw all that line of thinking out the window. I look at real interest rates. So the Fed funds minus break-even spreads. But that will tell you if the Fed is easy or are they tight. If they're easy, money supply will increase. And money supply increasing serves to increase the rate of inflation. Okay, that's just one of the 10 components I have for the inflation-deflation component. Those 10 components for the inflation-deflation dynamic. I have 10 for the growth and recession dynamic. So you have to predict where inflation's heading. You can't react to it because then you're in arrears and you won't make any money. So if one of my inflation metrics was, one of my inflation components was CPI or PCE deflator or shadow stats, that doesn't help you. You have to look at forward metrics. And one of the best things to look at, as I just mentioned, also yield curve. If the 210 Treasury spread is contracting, banks don't lend as much money. That's deflation or deflationary or disinflationary. When it's expanding, they're more incentivized to lend money. So I'm predicting and analyzing what's happening with what's going to happen with money supply, not what has already happened and shows up in shadow stats with a lag. Not going to help you.
Makes perfect sense. Yep. One more question. Nitro Burp asked, they keep harping on a reset. On January 2014, the IMF mentioned a reset. It did not happen. Why should it happen now? If so, why wait 6 years from when they mentioned it?
So again, a reset is something like a bail-in where they say, we're not going to pay you this amount of Social Security. You don't have this much money in the bank. We're bailing in Charles Schwab, not bailing out Charles Schwab, bailing out the financial system. So bailing in instead of bailing out. So a reset isn't going to happen until inflation fails, until the pursuit of inflation fails to fix what's happening in the economy. So that's years away, in my opinion. You first have to get to the point where central bankers say, oh my gosh, I am crushing the middle class completely. Economic growth is floundering because we have a Zimbabwe-like inflationary crisis on our hands. And the only thing we can do now is reset. We have a currency reset, a debt reset, debt jubilee. All those things are very deflationary, but you don't volunteer to do that because it means people will be starving to death. You'll have, you tell people you're not going to get all your Social Security. People will starve to death in the short term. It's great. It's the absolute correct thing to do in the long term. But in the short run, businesses go bankrupt. Banks go bankrupt. We have a record number of zombie companies. Look at corporate debt right now, Dunnigan. 50% of investment grade debt, 50, is now triple B, which is just barely above junk. You have that kind of reset, you're going to have, mass layoffs. You're going to have a depression like we've never seen before. The unemployment rate is going to spike to the moon. And why in the world would anybody voluntarily do that? The maniacs that control government have the hubris to believe that inflation is a panacea. You can bail out the stock market. You can bail out the real estate market. You can bail out the junk bond market. You can cure a virus. You can do a lot of things by printing money. That's what they believe right now. But until that belief is put asunder, until that belief is proven false, then you will not have any sort of reset to worry about.
I guess a lot of people have said to us that had we let free and open markets take their course, you would have gotten a lot of little resets along the way from natural organic causes, and those unhealthy zombie companies would have gone by the wayside a long time ago, and those people would have found something productive else to do rather than us just dragging those carcasses along and paying for it.
Perfectly said. One of the beautiful things about a market is it's got a cleansing, cathartic, purging kind of.
Everything in nature, it has its natural, yeah.
If you prevent the forest fire from ever happening, you're going to end up with one conflagration like we've never seen before. It's a similar dynamics. You got to clear out the brush once in a while. Let new shoots spring up, let old trees die, take them away, and you let the market function naturally. Okay, you let the market function naturally. You cannot artificially suppress something from happening for very long, and then it's going to blow up in your face. I don't know if that analogy works the best as it should, but you let freedom. What is market? What are markets but freedom? Let freedom work. You let people with. I'm sure the last typewriter that was ever manufactured was phenomenal. Or the best manufacturer of whiteout was beautiful. But you can't keep those businesses alive and growing forever. It just doesn't work. But that's exactly what we're doing. We're allowing businesses to survive by borrowing money to pay interest on existing debt. It just doesn't work. That's a man-made manipulation of what's happening. Okay? To make a better analogy, you allow small fires to clear out the brush rather than one big giant fire. Just makes sense, right?
Are you trying to tell me that I should stop using whiteout to fix typos on my word processor screen? Okay. Michael, we've been really benefiting from your insights, and if people want to get plugged in further to your work, where should they go?
Well, the website is pentoport.com. I have a podcast called the midweek reality check. It's only $49 a year, $49.99 a year. I think it's a 5-week trial. You'll get some 36,000 foot view of what I feel is happening in the economy. Obviously, if you want me to manage your money, if you have around $100,000, that's a loose minimum for us. My email address is mpento@pentoport.com. The office phone number is 732-772-9500. So call here. We won't jump on top of you and pin you to the wall. We'll gladly answer your questions and try to get you to become a client with very little pressure, because we only want people here that want to be here.
We'll put those contact info in the description so people, if you missed that, look in the description of the video. Well, Michael, thank you very much for joining us again here on Liberty and Finance.
It's always my pleasure.
I guess we just have to, as these volatile, unprecedented times unfold, we'll need to have you back here to keep us abreast of what's going on. So thank you very much.
Glad to do it. Thank you.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.